Starting a business is exciting and can be extremely rewarding. You have a great idea and you can't wait to bring it to market. But starting a business also requires a lot of hard work, long hours, sacrifices. It's really exhausting. But if it's done right, you could be very successful. But if it's done wrong, it could cause you endless problems, headaches, and even bankruptcy. Being an entrepreneur also means making tough decisions. How much should you charge for your product or your service? What software you should use? Who you should hire? Every day you're making decisions that impact your business. But the most important decision you need to make is deciding on how to organize your business structure. Choosing the right entity is crucial because it can have a dramatic effect on your taxes, the risk that you're taking, your partners if you have any, and your growth potential. While it is possible to change your entity structure later on, it can become really complicated, especially if you have partners. But what entity should you choose? Your friend tells you that you have to start an LLC, and then you watched a YouTube video that said the C-Corporation is the best entity ever, and then you just recently heard a podcast that said the S-Corporation is the most tax efficient. Well, now you're super confused, so which one is it going to be? The short answer is it depends. It really depends on your ultimate objectives and what you want to achieve with your business. The right entity structure really depends on your specific situation. There's really no one size fits all. You should really start by asking yourself a few key questions. Will you be the sole owner of this enterprise, or are you going to have partners or outside investors? How much revenue do you realistically expect to generate? Are you going to make $25,000 a year selling collectible plates on Etsy as a side hobby? Or are you going to make $500,000 a year as a chiropractor? What industry are you in? Are you in real estate, in consulting, tech? Are you going to actively participate in this business, or are you going to be a passive investor in the business? Are you going to have other owners or partners? And if so, are they all going to be US citizens or residents? Or are you going to have some foreign owners? Or is another entity going to own your business? These are some key questions you need to ask so that way you know what type of entity structure is the right one for you. Do you plan to offer stock incentives like RSUs or incentive stock options or non-qualified stock options? These two are important factors determining what type of entity structure you're going to have. Are you planning on going public and doing an IPO? Are you going to have a complex capital structure by having various share classes? Answers to these questions will help you narrow down the type of entity that's right for you. So in this video, I'm going to walk you through the main types of business entities, such as sole proprietorships, LLCs, S-Corps, C-Corps, and I'm going to explain which structure is the best suited for different types of businesses and their growth goals. Let's start off with the easiest one, which is a sole proprietorship. A sole proprietorship is the easiest business to form because there's so little that you need to do to actually get started. If someone pays you for providing a service or selling a product, then you just become a sole proprietor. Sole proprietors are also unincorporated. There's no formal entity structure like an LLC or a corporation. The owner and the business are one and the same, with no legal distinction. Also, sole proprietors don't have to file a separate tax return. Instead, they have to file a return on what's called the Schedule C on their personal tax return. So now let's go over some of the pros, the benefits of a sole proprietorship. Number one, it's easy to set up. There's minimal paperwork and minimal cost. There's no double taxation like I'm going to describe later on. Sole proprietors have what's known as a flow-through taxation. And I'm going to do a separate video on what is a flow-through taxation. Another benefit of a sole proprietorship is that you have full control to make any decisions you want without needing approval from other partners, shareholders, or a board of directors. Plus, you have a lot of flexibility to pivot quickly. If one business is not working, you can pivot quickly to something else without requiring a lot of headache. Also, there's a lot of ease of dissolution with a sole proprietorship. You can close it easily just if the owner decides to stop operating, the business itself essentially shuts down. Now let's go over some of the disadvantages of a sole proprietorship, and there are actually many of them. The first one is unlimited liability. There's no liability protection for you because there's no distinction between you as the owner and the business. You as the owner are responsible for all the business liability and all the risk. As a sole proprietor, you may be required to get a business license or a permit depending on when you're operating. Also, as a sole proprietor, you have limited access to capital. You can't issue shares or membership interest to outside investors. Also, it gives you less business credibility. Some clients or vendors or lenders, they view sole proprietors as less established and less trustworthy versus like a corporation or an LLC. Another disadvantage of a sole proprietorship is that they're subject to self-employment taxes on net profits. So if you're a sole proprietor and you have net profits, you have to pay self-employment tax plus income tax on that net profit. Lastly, there's no business continuity with a sole proprietorship. Once the owner dies, so does the business. But even with these drawbacks, the sole proprietorship is not necessarily bad depending on what your objectives are. If you have like a side hustle or doing some freelance work, the sole proprietorship is completely acceptable. If you're doing something on the side, you've got like a W-2 income, again, a sole proprietorship is completely acceptable. I mentioned earlier, if you're selling something on like Etsy or eBay and you're not making that much money, a sole proprietorship is an appropriate type of business structure to have. Things like local handyman, like local service providers, those two could be a sole proprietorship. Other examples could be like a personal trainer, a housekeeping services, a photographer, things where you're not generating that much money and you're the only person that's part of that business, and it may even be a side hustle for you. Then a sole proprietorship is probably appropriate versus going to the complexities of setting up a more formalized business. Now let's move on to partnerships. According to the IRS, a partnership is an unincorporated organization with two or more members who carry on a trade or a business. A single person cannot be a partnership. There are different types of partnerships. There is a limited partnership, a limited liability partnership, or a general partnership. A lot of people confuse an LLC, a limited liability company, as a partnership, but it's actually not a partnership. Partnerships are excellent structures for entrepreneurs who bring different skill sets to the business. So for example, you could form a partnership with a friend and you want to build an apartment building, but you contribute the raw land to the partnership and your friend contributes the money to the partnership for the construction costs. But then you can decide to split the profits 50-50. Even though you didn't put any money in, all you did was contribute land and your friend contributed the money. The partnership allows for this flexibility. This unequal ownership structure is not possible with a corporation. Only a partnership can accommodate such disproportionate ownership interests. And as such, a partnership should have a partnership agreement that outlines the key provisions of the partnership. So as I just described earlier, where one partner contributes raw land, the other partner contributes cash to the partnership, that partnership agreement is going to say that we're going to split the profits 50-50 or split the profits 80-20. Whatever the partnership agreement says, that's where you're going to go based off of. Partnerships file an informational return with the IRS on Form 1065. Now, it's informational because the partnership itself does not pay federal tax. The purpose of the 1065 filing with the IRS is to show the IRS how much each partner made or lost in the partnership, so that way that each of those partners could report that income or loss on their personal tax return. And they do this by what's known as a K-1. Once they file this 1065 partnership return, that partnership return generates a K-1 and it gives it to each of the partners, and then the partners take that K-1 and show their income or loss on their personal tax return. But the partnership itself does not pay federal tax. It's just an informational return. Now let's go over some of the advantages of a partnership. The first one is the ease of formation. Just like a sole proprietorships, partnerships are very easy to form. If you and I go into a business where I contribute the land, you contribute cash, and we want to build a property together, we've essentially gone into a partnership, even though we don't have anything down in writing, although we should have something down in writing. Another benefit of a partnership is you can have shared responsibilities and workloads. Duties can be divided according to each partner's skill and expertise or their interests. So for example, you can have one partner who's great at business development and the other partner who's great at financials. This reduces the stress and the burnout of running a business all by yourself. I mentioned earlier about the flexible structure of one partner contributing property and the other partner contributing cash. But you could also have a situation where one partner contributes a building, another partner contributes cash, and a third partner doesn't contribute anything but their expertise. There may be a general contractor who doesn't have money or the property, but they've got the expertise to build the property. Now, each partner has contributed different things, but they can decide that they want to divide the profits equally by 1/3. Again, the partnership is so flexible that it allows you to do these types of structures. Another benefit of the partnership is that there is no double taxation. The partnership itself does not pay federal tax, as I mentioned earlier. It just files an informational return. And then from that informational return, a K-1 is generated, and the profits and losses flow through directly to each partner on their personal tax return. Now let's go over some of the disadvantages of partnerships. General partnerships have unlimited liability. That means that each partner is personally responsible and liable for the business debts and the legal obligations of the partnership. A limited partnership or a limited liability partnership has limited risk. So you have to understand the differences and know what kind of a partnership that you're in. Another big disadvantage of partnerships is that they are subject to self-employment tax. Now, while a partnership does not pay federal tax, as I mentioned earlier, each partner is individually responsible to pay their share of the tax on the business profits. Plus, these business profits may be subject to self-employment tax if that partner is actively involved in the business. Also, guaranteed income from a partnership is also subject to self-employment tax. So guaranteed income is a payment to a partner for providing services to that partnership. And I'll do a separate video on guaranteed payments because there's a lot of nuances to guaranteed payments. Another disadvantage of a partnership is that there's lack of continuity. A partnership may dissolve if one partner leaves, they die, or they declare bankruptcy. So in my previous example, if you're contributing property and another partner is contributing cash and one partner passes, your partnership is essentially dissolved because it's only one person and you need two or more people to create a partnership. A partnership is also illiquid. It's hard to transfer ownership to someone else. So if you're a partner in a partnership and you want to sell your interest to another partner, like another third party, it's very difficult to find that third party that's going to want exactly the terms that you have within that partnership. Another big disadvantage of a partnership is that there's potential for conflict. Partnership disagreements happen all the time. In fact, there are tons of attorneys that focus entirely on partnership disagreements. Now, it's far too common. Now, disagreements can easily arise between partners over business decisions, the vision of the partnership, or even work ethic. Unfortunately, these conflicts can lead to strained relationships, slowed operations, and in some cases, the dissolution of the entire business altogether. But again, it doesn't necessarily mean that a partnership is necessarily bad. There are some businesses where a partnership makes sense. For example, real estate investments. Partnerships are very, very common among real estate investments because of that unequal pooling of money that I described earlier, or unequal pooling of money and capital. Another industry where partnerships are very common are professional service firms like accounting firms, law firms, or consulting firms. Typically, they form limited liability partnerships because they're trying to limit their liability. They're not general partnerships. Real estate funds, also known as syndications, are also very, very popular for partnerships. This is where investors pool money together and they buy or develop or manage properties. Partnerships are also common among family members running a business together, especially when there's different generations and contribute different strengths. Okay, now let's move on to C corporations. C corporations are the corporations that we hear about on a daily basis in the news. These are companies like Google, Apple, Amazon. When most people think of a corporation, they're thinking of a C-Corp. C corporations are super dynamic and are the preferred entity type for large companies or companies that want to become large, mainly because of their flexibility and because they have fewer restrictions. For example, a C-Corp can have unlimited shareholders, they can have complex debt structures or equity structures. The benefits of a C corporation are really long, but I'm only going to cover a handful of them that are the most important for a lot of people. The first one is if a C corporation is set up properly, you can have complete liability protection. C corps are completely separate from their shareholders, thus providing that limited liability that a lot of shareholders want. So let's assume that you own shares in ExxonMobil, and they're sued for some reason. And believe me, they have a lot of lawsuits. And you as a shareholder are not involved in that lawsuit. The only risk you have in that lawsuit is if that lawsuit is so large that it causes ExxonMobil to go bankrupt and you lose your investment. The person who's filing that lawsuit can never go after your personal assets. The only thing that you lose is your investment in that stock of ExxonMobil. C corporations are very, very flexible and can create very complex corporate structures. For example, Alphabet, the parent company of Google, has 3 classes of stock that allows its founders to retain control of the company. For example, Class A is publicly traded and has 1 vote per share. This is what most people buy when they buy Alphabet or Google stock. Class B shares are not publicly traded. They're only available to the insiders, and each share has 10 votes per share. So that gives them a unique ability to exert a lot of control over the company. And then Alphabet also has Class C shares, which are also publicly traded, but they have no voting rights. This equity structure, this entity structure, is only available in a C-Corp. You can't do this with an S-Corp, which I'm going to define S-Corps later on. C corporations also have perpetual existence. The corporation continues even if a shareholder dies. This is not the case with a partnership or a sole proprietor. Also, it's easier to attract investors, outside investors, because many investors, especially venture capital or institutional funds, prefer or require investing in companies that are C Corps, ideally Delaware C Corps, because of the flexibility and the different equity structures that a C Corp can provide, unlike some of the other entity structures. It's also easier for C Corps to offer employee benefits and stock options and have those be tax deductible versus some of the other entity types. And then lastly, C corporations are eligible for the qualified small business stock, also known as QSBS exemption, that allows you as a shareholder to exclude up to $10 million of capital gains upon your sale. This is massive, and it's a huge, huge benefit of a C corporation. Now, the QSBS is very complex, and I'll do a separate video just on that topic alone, but only the C Corp is eligible to do the QSBS exemption. Now let's go over some of the disadvantages of C corporations. The number one disadvantage of a C Corp is that it's double taxed. Now you may be wondering, how is it double taxed? Now let me give you an example. Let's assume that you own Apple stock and Apple earns a profit and it pays you a portion of that profit as a dividend. Well, when Apple earns that profit, Apple company, it has to pay tax on that profit. And then when it pays you that money in a form of a dividend, then you have to pay tax on that dividend. That is double taxation on the C Corp. Corporations have ongoing compliance requirements. They have to hold annual meetings, record minutes, maintain board of directors, and they have to file annual reports. If it's a publicly traded C corporation like Apple or Google, they have really strict reporting and governance rules that they have to follow. There's also less flexibility in deductions because it's not a pass-through entity. Now, if you're not familiar with pass-through entities, watch my other video I did where I go deep into pass-through entities. But in a C corporation, if there's a loss, it doesn't flow through to your personal return and be able to take that deduction on your personal return. Lastly, another disadvantage of a C corporation is that it's not eligible for the QBI deduction, the qualified business income deduction. Despite its limitations, the C corporation makes sense for a lot of businesses depending on what their objectives are. So for example, if your objective is to raise capital to go IPO, to go public, then a C corporation makes sense for you. If you're trying to attract venture capital or foreign investors, then a C Corp is right for you. Or if you're trying to create a complex capital structure with different share classes, if you're going to offer like incentive stock options like restricted stock units, non-qualified stock options, incentive stock options, or other types of incentive stock options, then a C Corp is the most appropriate corporation or entity to do that in. If you're planning on having unlimited shareholders, like millions and millions of shareholders, the C Corp is the appropriate type of structure to have. Or if you don't want to have any restrictions on the type of shareholders you have, again, the C Corp is the ideal structure. This flexibility is why so many multinational corporations, such as Nike, Amazon, Google, are all C corporations, despite the double taxation and some of the other disadvantages of C corporations. Now let's pivot over to the granddaddy of them all, the S corporation. And I say this because according to the Small Business Administration, 99.9% of all businesses in the US are small businesses with under 500 employees, and nearly all of those businesses are S corporations. Don't assume that S in the S corporation means small revenues. The S simply refers to the subchapter S of the Internal Revenue Code. There are many large S corporations that earn millions of dollars a year in revenues, so an S corporation is not limited by its earnings or the number of employees it can have. S corporations are just like C corporations, but what differentiates them is that they are super tax efficient because they are not double taxed like C corporations, and their structure helps them minimize payroll taxes. S corporations are not double taxed because all their income, losses, credits, and deductions flow through or pass through to the shareholder, and then each shareholder reports their portion of that pass-through item on their personal tax return. Just like in a partnership where the partnership generates a K1, the S corporation also generates a K1 for each owner, and that owner uses that K1 to show their income or loss within that S corporation. This is the reason why S corporations are known as pass-through entities. Now, it's important to note that you don't just become an S corporation. You have to apply with the IRS to grant you permission to be taxed as an S corporation. To do this, you have to file Form 2553 to be eligible to be an S corporation. Now, I'll define the eligibility rules when I go over the pros and cons of S corporations, but if you want a deeper dive into S corporations, I recommend you watch my other video where I talk extensively about S corporations. Okay, now that we know generally what an S corporation is, let's go over some of the advantages of an S corporation. The first one is no double taxation. S-Corps are pass-through entities, so their income and losses flow through to each owner on their K1s. That's not the same as in a C corporation. Also, there are potential tax savings on self-employment taxes because the distributions are not subject to self-employment tax. Distributions are only subject to income tax. S corporations also benefit from the qualified business income deduction, also known as the 199A, Section 199A deduction, which is really big. This was passed during the Tax Cuts and Jobs Act and was recently extended under the One Big Beautiful Bill. Just like C corporations, S corporations also have liability protection. And the last benefit of an S corporation is that you can have unlimited revenues. The S does not mean small. You're not capped by how much revenues you can have or the number of employees you can have. Okay, so now let's go over some of the disadvantages of an S corporation. The first one is if you're an owner of an S corporation, you have to pay yourself a reasonable salary if you're providing services to that corporation. I mentioned earlier that a C corporation can have millions of shareholders, but an S corporation is limited to only 100 shareholders. Now, there are some exceptions to family members, but the 100 shareholder rule really limits an S corporation's growth potential. There are also strict ownership restrictions. Not everyone could be an owner of an S corporation. Only the following could be shareholders of an S corporation: either individuals that are U.S. citizens or residents, certain trusts, certain estates, and certain tax-exempt organizations like 501c3s. S corporations are also limited by only one class of stock. So unlike a C-Corp that can have multiple types of stock, like I mentioned with the Google example, an S-Corp, you can't do that. You can only have one class of stock. But you can have different voting rights with different types of stock, but you can only have one class of stock. Also, S corporations have limited appeal to outside investors. Venture capital funds and outside investors typically don't like investing in S corporations because they prefer C corps because of that huge flexibility and complex equity structures they can create. Another disadvantage is that S corporations have strict qualification rules. The IRS can terminate your S corporation at any time if you violate these restrictions, such as the number of shareholders you have, the class of stock you have, or who owns your shares. And because an S Corp is a corporation, they too, just like C Corps, have ongoing compliance requirements. They have to have annual meetings, record minutes, maintain a board of directors, and do annual filing reports. But despite these limitations, S corporations are super popular and they're very, very common among business owners. Business owners such as professional service firms like CPAs, lawyers, doctors, architects, anyone who's really providing a service for that business, that's very common to be an S corporation. Family-owned businesses are very commonly S corporations. These are things like restaurants, retail, manufacturing, distribution. Social media influencers that make a lot of money are very commonly S corporations. Freelancers or contractors that also have an ample amount of revenues, they too are S corporations. So as you can see, S corporations are very, very popular among a lot of business owners. And the last entity structure I want to talk about are LLCs, also known as limited liability companies. Now, LLCs have become increasingly popular among entrepreneurs and small business owners because of their flexibility and their liability protection. LLCs are very unique because they have a hybrid structure. An LLC can choose to be taxed as a single member LLC. They can be taxed as a partnership. It could be taxed as an S corporation, or it could be taxed as a C corporation. To form an LLC, you need to file an articles of organization within the state that you want your LLC to operate in. By default, a single member LLC is owned by one person and is considered a disregarded entity, just like a sole proprietorship. A multi-member LLC is taxed as a partnership or is treated as a partnership. Now, if you form an LLC with one or more individual, it's by default taxed as a partnership unless you elect to be taxed as a corporation. And as such, you can decide if you want to be taxed as an S corporation or you could be taxed as a C corporation. So as you can see, the LLC is very, very flexible, and it's a hybrid structure because you have a lot of flexibility in how you want your LLC to be taxed. A lot of people get confused by LLC, so I'm going to do a separate video where I explain everything about the LLC structure and its taxation. But the purpose of discussing LLCs in this video is to talk about the pros and cons of LLCs and some common businesses where LLCs make sense. The first benefit of an LLC is its limited liability protection. It's right there in the name. LLC, limited liability company. Also, I mentioned earlier that an LLC has flexible taxation. It could be treated either as a partnership, an S corporation, a C corporation, or a single member LLC where it doesn't file a federal tax return. All it has is treated as a disregarded entity, like similar to a sole proprietorship. Another benefit of an LLC is that it has fewer formalities and compliance requirements relative to corporations, whether if it's a C corporation or an S corporation. The LLC also has ownership flexibility because there's no restrictions on the number of members you can have in your LLC unless your LLC is taxed as an S-Corp. And if that's the case, you still have to qualify as an S-Corp with the number of shares or number of shareholders and the type of shares you have. Now let's go over some of the disadvantages of an LLC. The LLC has limited growth potential because the LLC does not issue stock. It has membership interests. Also, the transfer of ownership is harder with an LLC versus a corporation because the LLC has membership interests that are illiquid. You can't as easily trade those like you can with stock. Because an LLC is a hybrid structure, its limitations are the same as its tax status. For example, if an LLC is taxed as a partnership or a single member LLC, then it's subject to self-employment tax, which is a disadvantage. If an LLC is taxed as an S-Corporation, then it's subject to the qualifications of an S-Corporation, such as the number of shareholders it has and the type of shareholders it has. If the LLC is taxed as a C-Corporation, then it's subject to double taxation. As you can see, each type of entity structure has its unique pros and cons, and you should select the entity structure that meets your needs and your objectives. So for example, if you're looking to raise external capital, then a C-Corp is the right one for you. If you're thinking about just selling things on the side as a side hustle and you want to make a little bit of money, then a sole proprietorship is probably the best option for you. But if you're going to be operating as a professional service business, such as like a CPA or an architect or a lawyer, then an S-Corp may be the best option for you. And then lastly, if you're going to own real estate or be in a partnership, then an LLC taxed as a partnership may be the best option for you.